Think back to the last time you borrowed money. Maybe it was signing up for a credit card, taking out a line of credit, or even getting a mortgage. There's a good chance you were also offered insurance on that loan, something that will pay off the debt or keep up with payments if anything happens to you. And you might have thought, but I already have insurance from my job or maybe my partner's job.
And a lot of people think that that coverage is sufficient. It probably is not.
That's Wayne Hewitt, our guest this episode. And the type of insurance he's referring to is called creditor insurance. And as budgets get tighter for most Canadians, it's something a lot of people may not initially see the value in.
Yeah, I would challenge them to think about that really hard. And if that debt is being used for something really important for your family, for your legacy, then it's really important that it be protected.
Wayne is the Senior Vice President of Insurance Canada at Scotiabank, and he's here this episode to shed some light on this often overlooked type of coverage. He'll explain why creditor insurance is so important, give you some tips on how to make sure you're not underinsured, and even bust some common insurance myths.
Because it's really important that people understand that accumulating assets is great, but you need the safety nets should things that we don't want to happen.
I'm Stephen Maurice, and this is Perspectives. Wayne, thanks so much for joining us today.
My pleasure.
All right, we're going to jump right into it. So we'll get into the details of this, but maybe you can just tell us in a sentence or so, what is creditor insurance?
Sure. Creditor insurance is a life and health insurance policy that attaches to a credit product, a mortgage, a credit card, a line of credit, and it's designed to either liquidate, completely pay out, or service a debt should adverse events happen to the person protected.
So when you're going to take out a significant loan of some kind, or you're using your line of credit or whatever, this would be a product that would be offered to you by the financial institution that's lending you the money that would help cover those payment expenses in the event of something happening.
Correct. So let me step back a little and talk a little bit about why people take out insurance.
Yeah.
And there are really three reasons that people take out insurance. One is they're interested in making sure that they take care of their final expenses. They don't want it to be a burden to their family, and they want to deal with, final arrangements, funerals, etc. So that's reason number one. Reason number two that someone would take out insurance is because they want to make sure that their income can continue to be provided to their family once they've passed away. So sort of income replacement, meaning my job was contributing X dollars per year. When I pass away, my family will be denied that income. So I take out insurance to kind of supplement that and provide them with income for expenses going further. And then the third reason would be for debt reduction. So we want to make sure that when we pass away or some other adverse event happens, that insurance is able to either extinguish the debt or continue to service the debt until I get back on my feet. So those are kind of the three reasons that people take out insurance. Creditor is focused on that last piece,
right?
Making sure that as you take on debt, you're leveraging your future earning power. You're leveraging your future income. And if we think about a mortgage in particular, you're banking on your ability to earn over the next 25 years or 30 years or 20 years, whatever the amortization is. Yeah. And we hope nothing happens in those periods of time, but there are a number of adverse things that could happen. So you're taking on a risk when you're borrowing, and especially when you're borrowing for a really important asset like a home or a car, et cetera. So it's an opportunity to provide protection for that, so that if an adverse event happens, you're able to either extinguish the debt completely or service it until you get back on your feet.
Right. So it can protect you in the event that you're not able to work or you lose your job or some other circumstance, but potentially also protects other people, your family, if one person is the main income earner in a family, or even when both people are working, but you depend on that. You're protecting your family as well as yourself.
100%. I think any income in the family is important to cover off in the event of loss. But even if your partner is not an income earner at all, it's important to consider their coverage as well. And just thinking off the top of my head, there's an example of a family that we protected a couple months out where the wife was not an income earner. She was a stay-at-home mom. and the husband was the main income earner, but his job caused him to travel quite a bit. And they had small kids, and so her role at home was taking care of the kids. So when she passed away, it became difficult for him to do the job that he was doing all along.
Right.
At that point, he realizes how expensive childcare is and had to make adjustments in his own income earning to be able to take care of his family with the loss of his loved one. So creditor insurance can come into those spaces and help alleviate some of those additional costs and expenses by taking the burden of the debt away. Mm-hmm. So it's important to think about covering the main income earner or the primary income earners or all income earners. But it's also important to think about people who are not income earners, because those people are making contributions to the families in ways that are not always summarized in dollars and cents.
Right.
And that's something that a lot of people miss sometimes.
Right. And you talked about how in some circumstances it would clear the debt entirely. In others, it might just make payments for a given period of time? I mean, how do you choose if you're buying that kind of insurance? Is it for some period of time that the payments will be made? Do you have options in how you can approach that?
Yeah, it really depends on the type of coverages that the insured person selects at the time that they're taking out the insurance. Obviously, if for life insurance, the policy will totally extinguish the debt. Should the person pass away, it will pay the debt off completely. For some of the other coverage types like disability or critical illness or job loss, it will cover it for a period of time until the person gets back on their feet and will just be contributing debt service as it goes along.
And you're paying some kind of premium on this
Correct.
To buy this insurance,
Correct.
As you would with any insurance.
Correct.
Okay. Another type of insurance that people may be familiar with or may not be is term insurance. What is that, and how is that different from what we've been talking about?
Term insurance is an insurance policy that you take out for a defined period of time, 5 years, 10 years, 20 years, or 30 years. It's similar to creditor insurance in that the primary purpose of it is debt replacement. Typically, someone would take out a term insurance policy because they have debts. They figure that they're going to have those debts over the next 10, 15, 20 years. And so they take out a term insurance policy to kind of match that tenor so that on the occasion of their death, it will be available to totally extinguish the debt. So the purpose of it is aimed at the same thing as creditor. Both are aimed at debt reduction. I guess the differences between the two are creditor is really very convenient. It's offered by your financial institution, the same person you're taking the debt from. So it's really convenient to get at the same time you're getting the debt.
Right.
And then at the time the claim needs to be paid, it's really convenient because they're both at the same place, to get them extinguished together. Whereas for term life, you'd have to go and get it separately from your debt. And at the time of death, there's a lot more steps involved in applying that insurance to that debt.
Right.
Also, creditor tends to be a little bit more cost effective. It considers the amortization of the loan more clearly. So those are some of the differences between the two. On the other hand, term could be more portable, meaning I could use it to cover debt 1 today and debt 2 tomorrow. And, if I pay off this debt and take on another, or have debts at multiple financial institutions, it could cover all of my debts.
Right.
So I guess the key difference is really preference, right? For creditor, there's a convenience factor. You can be sure that that debt is going to be extinguished. Right. So there's a lot of convenience and efficiency, both in terms of cost and in terms of its application. And for term, the difference is portability, and that's the attractiveness of that. So depending on your preference or where you are, both types of insurance are helpful for debt reduction.
So, for instance, with term insurance, maybe you've got $300,000 left on your mortgage, so you might get coverage for a specific amount so that at least your mortgage would be covered off in the event that you died. But then, you don't die right away and you're paying off your mortgage, so you have some of that coverage available to cover other debts that might exist.
Yeah, both serve that purpose. They're covering the debt. Another difference, I suppose, with creditor is that it does extinguish the debt and it's done. There's more of a process to apply the term insurance proceeds to the debt. And if the debt got paid off, the term might still be there because it's independent of the debt, whereas creditor is attached to the debt. Another important difference between the two is that term insurance is a life insurance policy. Yeah. If you wanted to get other coverages, you'd have to apply for other types of insurance to get that. With creditor, it's a lot easier to add disability coverage, critical illness coverage, job loss coverage, all in the same underwriting process. So again, that comes with the convenience of that product, and it allows you for broader coverage opportunities than a term life policy might.
Right. So when somebody's going in to get a mortgage, they'll be offered creditor insurance, and they might think, oh, this is just an extra expense, and already buying a house is expensive enough. What do you say to somebody who's thinking, well, I don't really need this?
Yeah, I would challenge them to think about that really hard. It is an extra expense. There's no question about it. It's another thing that you have to pay for. A lot of times we ask people, can you afford not to have it? The bigger your purchase, the more risk you're taking as a borrower.
Sure.
And if that debt is being used for something really important for your family, for your legacy, then it's really important that it be protected. So we often ask people, can you afford to not have protection? If something adverse happens, what are your options? It's really to liquidate your other resources to extinguish the debt. And that can prove to be more costly than the accumulated premiums over time of an insurance policy. But I also think that people need to think about the bigger the acquisition you're making and the bigger the debt you're taking on, the more risk you're taking on. And insurance is a really effective way to mitigate that risk over time.
And does that vary depending on a person's age or their financial situation? I mean, obviously you're saying everybody should be thinking about this, but do you tell someone something different if they're 25 and buying a house, or they're a different age or taking on debt at a different point in their life?
No, I think if you're taking on debt, no matter at what point in your life you're at, it's important to consider insurance in general and creditor insurance in particular. One of the things that most financial institutions do when they're offering the product is that they go through an assessment process to kind of better understand your age, your stage, your preferences, how much coverage you already have in order to determine what's the right plan for you. So it's not one size fits everybody, but I think it's important for everybody to consider creditor insurance as part of their overall insurance plan. And they should be thinking about an overall insurance plan as part of an overall financial plan. Remember what I said before, insurance is about making sure your final expenses are taken care of, but it's also making sure that there's continuity of income for your family and that your debts can be extinguished. So that's not a burden on your kids and on your estate. It's important to consider insurance, because if you don't and you self-insure, you're also taking on a risk that you might lose your house, or that you have to liquidate assets and reduce your wealth in order to extinguish those debts. Insurance is a practical way to cover off that risk as part of an overall financial plan.
Yeah, because someone might have some insurance through their employer, life insurance or disability insurance, but I guess if you lose your job, then you don't have that anymore either, right?
There you go. And a lot of people think that that coverage is sufficient. It probably is not. There are a lot of people that are underinsured today. And again, the level of insurance really is dependent on your age, your stage in life, how much debt you have, et cetera. But a lot of people are underinsured, and relying on your group health insurance or your group life insurance through your employer has its limitations. To your point, if you lose your job, then that insurance goes away and you have to start all over again. Probably older, with more probability of underwriting declines. So the earlier you get insurance, the better. At your peak health, that's the best time to go and get it. And relying on your group insurance through your employer is risky. Let's talk about disability, for example. Most employers provide disability insurance as part of that group health package. But at best, it covers 60% of your income, meaning if you have to access it, you're going to take a 40% haircut on your salary. Can you continue to service your debt with a 40% salary haircut? So having disability insurance as part of your overall creditor insurance plan allows you to maximize the income that your group health insurance will pay you during a time of need.
You mentioned underinsurance, being underinsured. What does that mean, and how do you address that?
That's a good question. It really is going to depend on your age, your stage in life, and the amount of debt that you have. I mean, a rule of thumb that I hear spoken around the industry is 7 times your income. You should be insured up to 7 times your income. It might be more than that or less than that, depending on what your debt load is. But again, how much insurance you have should really be able to help you do the three things that I talked about. Being able to prepare for your final expenses, be a substitute for your income so that your family can continue to afford the quality of life that you were giving them when you were alive. And thirdly, to extinguish debt. None of us want to pass on our debts to our kids. So I think you need sufficient insurance to be able to do those three things. It could be as much as 7 times your earnings. It could be less. It could be more. It really depends on what those variables are for you. And so a conversation with your financial advisor to go through all of those things is important before you buy. It's not sufficient to just say, I need $300,000 of insurance or $500,000.
Right.
There's really that calculation that needs to happen to make sure that you are ensuring the quality of life for your family when you pass along.
As your circumstances change, I guess you reevaluate all of that stuff.
100%. So it's important, I think, for people to, on a periodic basis, reassess what their insurance coverages are and whether they need as much or whether they need more coverage. And certainly when you're taking on additional debt, you definitely need to do a review of what your insurance coverages look like.
Okay, somebody's going in, they're going to get a mortgage or some other kind of significant loan. Do you have any tips for them? What are the questions they should be asking about creditor insurance as they go through the process?
I think it's really important that the person that they're talking to is walking them through an assessment. They really need to make sure that the right questions are being asked in terms of what their existing coverage is, what the size of their debt is, what are some of their future plans. If it's not a real conversation, then you could end up doing something that's not in your best interest. So it's really good to have that conversation. But I think if you are taking on additional debt, it's important to look at your insurance plan and make sure that you are covered.
I've heard insurance referred to as sort of a form of wealth preservation. Can you explain that concept?
Yeah, I think it comes back to what I said before. If you don't have insurance, then your options when things go sideways is to liquidate your assets.
Right.
And you spend a lifetime accumulating assets for your own enjoyment and to pass on to your estate and to future generations. So it's a means of protecting that wealth because adverse events happen. They just do. And no one wants to be in a situation where they have to liquidate their assets or reduce their equity in order to deal with their debt. So this is why insurance is an important part of preserving your wealth. It allows an external solution that you've acquired to extinguish your debt or pay down your debt without having to liquidate your assets. And so you preserve them for yourself and for future generations.
Right. And that would certainly apply to mortgage and owning a home, because for so many people, that's a large part of their retirement planning is the equity that they have in their home and so on. But what are some other circumstances? What are some other types of borrowing where people should be thinking about this?
Yeah,
I
think for all kinds of borrowing, you should be having a conversation about it, particularly if borrowing that you're doing is going to be non-revolving. You know, one of the biggest causes of bankruptcy is credit card debt. Yeah. It's a revolving line of credit, but sometimes we're not able to pay off our balances, and so we have a accumulated balance. So creditor allows you to cover not just mortgages, but also car loans, as we spoke to before, or any other bank loan that is consolidating debt. It's available to cover your credit card debt. It's available to cover your line of credit debt. Right. A lot of people use their lines of credit to do home renovations and things like that, where they're carrying a balance for a little bit of time and paying it off as they go. So not just for mortgages. I mean, that's the most common application. But I think as you think about any debt that you might have, having a plan to liquidate it or to deal with it or to service it when bad things happen is really, really wise, and it's really, really smart to do. And creditor insurance is a wonderful way to do just that.
What would you say are some of the main misconceptions about insurance?
Two things come to mind. One is something that we talked about earlier, that I have enough coverage through my employer, and so I don't really need it. And I think we talked a little bit about why that's not true. Obviously, your insurance through your employer goes away if you lose your job. And there are limitations to what that covers. We talked about the fact that disability doesn't give you your full income when you take it from your employer. And not many of us can live with haircuts on our salary during times when we can't work. So that's a misconception that that's sufficient. It's not. I guess the other misconception is that the insurance company doesn't want to pay the claim. Like insurance companies don't want to pay claims. And that couldn't be further from the truth. You know, we look at our role as being the opportunity of the bank to align with our clients on their worst days. We're there for them on their best days. We're there for them for their first house through a mortgage. We're there for the first car. We're helping them save for their children's education with our ESPs. And the insurance business, as part of a bank and financial institution, is that opportunity to come alongside our clients to make sure that they're able to weather those hard moments and not just be there for the good days.
All right. Before we wrap up here, what's the main thing our listeners should take away from this interview?
I think thinking about insurance more dynamically is really important. Don't be afraid of having the conversation with your financial advisor. In fact, you should insist upon it. Make sure that that's a proper needs-based conversation. Remember that you're taking on risk when you borrow, and insurance is a really good way to mitigate that risk. It's important that people understand that. Accumulating assets is great, but you need the safety nets should things that we don't want to happen.
Wayne, thank you so much for joining us today. It's been a really interesting conversation.
Thank you very much.
I've been speaking with Wayne Hewitt, the Senior Vice President of Insurance Canada at Scotiabank. The Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives.